Hello, everyone. Today on the Final Bar, we'll do our normal Monday routine, which is where we approach the market from three different angles. The big picture macro angle. What are the overall trends in the market? The S&P coming back below that 4,700 level, but also some key movements, things like cryptocurrencies and elsewhere. We'll talk about sectors, utilities breaking out to the upside, defensive stuff like REITs and consumer staples to the upside as well. And a number of individual names and groups to focus on, including pharmaceutical space. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to this Monday edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using technical analysis and the technical toolkit to better understand investor behavior and market dynamics. Interesting day today. You had sort of had the big sell-off. Three parts to the day, I would say. The first sell-off in the morning, we opened, reopened the markets near Friday's close, just about 4,700, went well below there. Afternoon after lunch, actually moving steadily backwards to the upside. And as I'm preparing for the show today, I'm thinking about this overall lower, but starting to show some signs of life. But big distribution going into the end of the day, finishing at the lows of the day, the S&P just below 4670. There's been very much a defensive feel for much of the day. The only three of the four sectors that are up, super defensive: staples, REITs, Utes, healthcare up there as well. Everything else down, and some of the sectors like consumer discretionary down fairly significantly. Let's try to make sense of as much as we can in 30 minutes. It's a fine challenge to take on. We have great guests on the show. Had so many great discussions in the last couple of weeks. Super thankful for that. This week, three great guests for you. On Tuesday, the 14th, Jonathan Krinsky, coming to us from New York. On Wednesday, the 15th, Ms. Schneider from Market Gauge. On Thursday, the 16th, Sam Stovall from CFR Research in New York. Also, our next episode of The Pitch is coming up on the 16th. Should be a really fun experience. We have three guest commentators all pitching you 5 ideas each. I'll be moderating that discussion. It is a fantastic time, and you will leave with a bunch of tickers jotted down on a piece of paper to dig into a little bit further. Go to stockcharts.com/thepitch, by the way, to find more information on that. I'll be doing the next episode or next edition of my free webcast series. If you go to marketmisbehavior.com/market trend, I'll be doing a session called Designing a Market Trend Model. We'll talk about that weekly market trend model that I use a lot of times on the show. Usually every Friday, we'll look at it, at least for a little bit. We'll go dig in a lot more detail about how that model was constructed, why having a market trend model can help you make sense of things, how to design one of your own if you'd like to go through with that. But at the very least, it'll give you a much better sense of the trends underlying the market movements that we see. Connect the short term to the long term. Sign up for that event. Go to marketmisbehavior.com/market trend. Finally, go to stockcharts.com/special. We have our holiday special going through year end. This is a really good time to join stockcharts.com as a premium subscriber. We have 3 different levels with different features that are added to each one of those. And really a lot of the great, the most effective content, the best tools that I'm able to showcase on the show. You really can only take advantage of those if you're a premium subscriber. So I'd encourage you to go to stockcharts.com/special for more information. If you've never tried it before, now's a really good time to do so. You can always add on to your existing subscription as well. Let's continue on with today's market recap. As I mentioned, 3 phases to this day: the sell-off, the recovery, and then the final leg lower, with the S&P closing just below 4670. That's down about 0.9% from Friday's close. Mid caps about the same, small caps a little bit more, down 1.7%. The NASDAQ 100 down 1.5%. The VIX back above 20. That's after going back below 20, after that spike into the 30s not too long ago. Interest rates overall coming off, with 10-year yields coming back down around 142. They'd gone around that 150 plus level in the last week or so, coming back off a little bit. Overall remaining fairly elevated from where it had been earlier in the year, but still below the peak of around 175 from earlier in the spring. The dollar index continuing to push higher. That stronger dollar environment is seeming to persist, even with all this movement, all this uncertainty in other asset classes. On the commodity side, the only commodities up are gold and silver. The rest sort of down for the day. Energy down pretty significantly, looking at the XLE, which is the worst performer of the 11 S&P sectors. And once again, a lot of red on cryptocurrencies. I feel like we've been saying this a lot, and we have. So Ethereum, notably below 4,000. We've talked about big round numbers like 60,000, 50,000, 40,000 on something like Bitcoin, on Ether. 4,000 has been a significant level to pay attention to. So worth looking at those charts. We'll see if we can get to them here with the time that we have in our market recap segment. But pay attention. With cryptocurrencies, I always tell people there's potential for plenty of upside. There's also potential for plenty of downside. In most investing scenarios, you can't have one without the other. You take on, or you have the opportunity for greater reward given the capacity for greater risk. And you're certainly feeling that on the downside with some cryptocurrencies recently. Looking at a chart of the S&P 500, so this drives home. I sort of have this brown shaded area highlighting that 4,700 level. If you think about what the market has actually done, the last big push higher, making new all-time highs, eclipsing the previous, extremes, and then, going even further forward was in early November, right? Late October, early November, we had this 2-week period where we really pushed above 4,550, got up to 4,700. From there, it has been a choppy sideways market. We've had a drawdown of about 5% from the peak there a couple of weeks ago to the low that we saw in early December, but we've now round trip back to those previous highs. So we have an established level of resistance, and on a day like today, closing back off of 4,700, the market has demonstrated its ability to reach 4,700 and its inability to go much further. So this is a stalled market, is how I would describe it. If you know flying, I'd call this a power on stall. This is something that's trying to take off and basically stalling. It's not really losing any altitude, but it's not gaining any anymore. And the problem is that's not a great way to start your flight or to continue your flight. It's to not gaining more altitude when you really want to do so. So it's worth noting that 4,700 level has been incredibly important. On the downside, 4,550. This feels more and more like a range-bound market and less like a directional market. As much as we want to think of this as in a bull market phase, moving higher, and there are plenty of stocks certainly making new highs. That is totally fair. Overall, the market itself, though, is stagnating, right? It's sort of in a sideways phase. I think 4,700 remains the most important level to look at there. The other, just a couple quick charts before we get to our next segment on sectors. I mentioned cryptocurrencies. I'll show you very quickly. So cryptocurrency is really in a bit of a free fall here today. And again, that the severity of the move may be a surprise to you. The direction of the move hopefully is not. We've been talking about the deterioration in cryptocurrencies with Bitcoin, breaking down some of these key Fibonacci levels. 54,000 was an important one that it bounced off of in late November and then failed. We now reached the 61.8% moving out, 61.8% level. Also the 200-day moving average, which is right about at where we're trading right now, around 46,500. The floor here is around 44,000. That would be the 61.8% level, and also lines up with some previous support levels that we've been focused on over time. Below there, 40,000, really an important one. That's from the September lows there. So you have a couple key support levels below the current levels. But, again, when you think about this overall trend, this is a market in a distribution phase. And I don't see anything other than that on this chart right now. You could look to take a position in this sort of environment. Just, bear in mind you are buying the falling knife sort of strategy, which can be profitable. You just have to make sure that you define your downside risk effectively. Ethereum, similar sort of a problem where it's breaking down through support, but this is a little more suspect, I would argue. While Bitcoin has been in a bit of an established downtrend, Ethereum has been more range bound. It's been more sideways between 4,000, we'll call it 4,800 in the last 10 weeks or so, right? So getting above mid-October, maybe 8 weeks, and then it's been in this sort of range. We've now broken below it. Today took us significantly below that 4,000 level for the first time since back here in October. This has been an established area of support for quite some time, and I'm concerned by the fact that Ethereum is breaking below that support level. Also, the RSI is getting just below 40, and it's remained above 40, which is more characteristic of a bull market phase. We're now breaking below the 40 level, which tells you the momentum is overall skewing more negative than positive. So I'm seeing a lot not to like in some of those charts. I would tell you long-term, some of these charts I think could certainly be materially higher down the road. But right now, from a tactical time frame, you're certainly not feeling that strength today. Let's continue on. We've now talked about the big picture, overall stocks doing well, but coming off of those all-time highs, 4,700, so important. A lot of weakness in other asset classes, particularly cryptocurrencies that we highlighted. Let's go into our next segment, sector setups. Let's look at the 11 S&P sectors. Using the RRG, this is the relative rotation graph that Julius de Kempener designed. If you're unfamiliar with this methodology, look up Julius's show Sector Spotlight. It does a great job of highlighting this approach to visualizing the sectors and how they rotate around the benchmark, which is here at the crosshairs in the middle. Now, if you look at this chart, basically things move in a clockwise motion. You want to start looking at things that are working. And what I note is there are a couple sectors that are in the leading quadrant, 3 of them: consumer discretionary, energy, and technology. Only one of those 3, though, is heading northeast, what I call the direction of improvement, right? This is a sector that has is a strong momentum, strong upward trend, strong relative performance, and improving momentum, and that's technology here in the leading quadrant heading northeast. The other 2 are in the leading quadrant, but they're heading the right direction. So while the relative performance has still been fine, the momentum is drying up. The momentum's coming out of that trade. So on this long-term rotation that we're looking at, technology is certainly in the most ideal setup here. After that, you look down here to something like materials, which is in the improving quadrant and heading in the right direction. Maybe even utilities and utilities and consumer staples, which are these 2 sectors right here. Industrials right over here. So you have some cyclical and some defense actually rotating up in the improving quadrant, but heading in the right direction. And those are the sectors certainly to keep an eye on. Where you want to lean away or sort of not think of as a great opportunity are these sectors that are in the lagging quadrant and heading southwest. Only one of those right now, communication services. Financials, by the way, just entering the lagging quadrant. I think it's a little early on to declare that a dead sector, a destructive trend, but communication services certainly an outlier. So if you look at technology versus communication services, when people ask me about sector rotation, I think you can see some clear differentiation between what's working and what isn't, and especially how that picture has changed just in the last 6 to 8 weeks, as you've seen these sectors continue to rotate. So technology is certainly the strongest. Very interested to see if you can get a rotation back higher on energy or consumer discretionary, but right now you're not really seeing that play out. Now we look at the 11 S&P sectors using the candle glance function. So this is sort of laying out all the sectors on the page and seeing how they relate. So at a visual glance, look across these 12 charts. You have the S&P down here on the bottom right. The rest, you have the 11 S&P sectors in kind of a random order. It's in order of their names, but it's not a super meaningful order, to be honest with you. My question is, which of these sectors are breaking out? Which of these 11 S&P sectors do you see making new highs recently, even today? There's not many of them, but there are a handful. You start from the top, consumer staples. And one of the offense versus defense ratios we've talked about many times is consumer discretionary versus consumer staples. If you take that consumer space, are investors overall rotating more to the offensive side? Things like luxury goods, retail goods, discretionary purchases, things you don't need necessarily, but you want, versus consumer staples, things like alcohol, beverages, toilet paper, household goods, cleaning things that regardless of what's happening around you and how much discretionary money you have to spend, these are the things that you don't necessarily want, but you absolutely need. So it's whether, are we spending our money on what we want or what we need? And as you can see from the fact that consumer discretionary coming off, making a lower high, and bouncing off the 50-day moving average potentially today versus consumer staples, eclipsing and making new all-time highs. Let's look at one and then the other. Here's consumer discretionary. Now, granted, we are not far off of all-time highs. So I'm not saying this is a disaster. I'm not saying it's an absolute horrible example of a bearish chart. It's not that bad yet, but it's certainly not going higher anymore. And it's starting to show signs of distribution, particularly in the relative strength. This is the relative strength line. Looking at consumer discretionary versus the S&P, we can see it's making a new 2-month relative low. So pulling back to the 50-day moving average just recently made a swing low, and the relative strength rolling over. Compare that to the chart of consumer staples, where you see the index making a new high, breaking above its highs from 2021, making a new all-time high again this week after Friday's rally. The relative strength actually starting to make a new relative high. The relative strength on consumer staples hold the phone, actually rotating higher and potentially starting to break out. One of the key measures that we've talked about is offense versus defense. Which side of consumer are people in? What you're seeing recently is a rotation out of consumer discretionary into consumer staples. The more that rotation persists, the more it tells you that investors are getting defensive, the more it tells you that they're taking their foot off the accelerator and starting to get a little more nervous about potential downside. Technology, I mentioned another sector doing fine, a bit of what we call a bearish engulfing pattern today, right? So you have the big up day on Friday, higher open, closing below the previous day's open. That's called a bearish engulfing pattern. It tells you short-term weakness fairly likely, but again, the long-term trend in technology has been incredibly strong with relative strength up and to the right. And again, continues to be the type of chart that I would tend to think of as a core position. Do you see any other sectors making new highs today? Two, and they are super defensive. And this is why I wanted to finish here before we take our break. The utilities sector. We talked about the emergence of utilities. When someone asked me, what would you look for that would make you less bullish on the overall environment going into year end? And my comment, one of them probably was utilities starting to work. Investors indicating that they're rotating into a very defensive sector like utilities. You don't own utilities if you think the market's going to do well. You own utilities if you want yield, if you want income, and if you want to ride out in an area of relatively low volatility, ride out some market uncertainty. So the fact that UTs are making a new all-time high, the fact that the relative strength is just starting to improve is potentially an area of a concern. You're seeing a very similar pattern with real estate. Real estate tends to be a higher yielding sector, a little more defensive, way to ride out market volatility and have a good income component as well. So again, it's still early days. It's not like the relative strength line is exploding on any of these, but it's certainly stronger relative than weaker. And you're seeing investors clearly rotate to these defensive sectors. I would argue between now and year end, especially going into the new year, that improvement in the defensive areas of the market is a really key theme to pay close attention to. We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hey, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we break down these markets from a technical perspective. A couple quick announcements before we get to my next segment. First off, we love to hear your questions. Anything that's coming up as you are trying to use charts to answer your questions as an investor. What are you trying to accomplish? How are you using charts to try to do that? And what are you running into? Any questions on technical indicators, on market history, on market dynamics, on breadth, sentiment, whatever it is, we're here for you. Our email is the best way to get your questions to us, thefinalbar@stockcharts.com. We're on Twitter. Just tag us in a comment at FinalBarSCTV. We're on YouTube. Put a comment below the chart, the video you're watching on our Stock Charts channel. We'll gather all those questions and we'll hope to answer one of yours live on the air in our next mailbag segment on Tuesday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. So much great content. I was just talking with our team earlier today about our plans between now and year end. We have a bunch of special programming in the last couple of weeks of the year. It's really, really well done. A market outlook coming up in January. All of that you can watch on demand from the website, StockChartsTV.com. Also on your mobile device, just go to any of the app stores and search for Stock Charts TV on demand. Let's continue on today's show with our next segment, Shifting Stocks. We started big picture overall markets, not too far off of all-time highs, looking at the S&P and the NASDAQ. But when we looked at sectors, you're seeing a real emergence of some of those defensive sectors. And the question is, is that sustainable? And more sustained improvement, particularly on a relative basis, in the defensive sectors should tell you that institutions are starting to rotate more on the defensive side of the coin. That is not an encouraging sign for, much further upside for stocks as a whole. Our final segment now completes this transition from macro to micro, this process of looking big picture to smaller picture. Let's look at some individual names and themes and see what we can come up with. A couple of things that came up to mind. We'll look through this segment, just charts that have stood out to me today. So you have one of the top performing group when I checked when we were starting the show, the pharmaceuticals group within the healthcare sector. Now, a lot of these names are names that we've been following fairly close, and I'm sure you probably have a lot of news flow around these names like Pfizer and Moderna for obvious reasons. These are the companies involved in pandemic issues and vaccinations and all of that. So let's get away from the narrative as much as we can. Just focus on the charts. What are the charts telling us about the investability of this particular theme and some of these charts? So what's interesting about Pfizer making a new closing high today, up 4.5%. So a nice move higher. This is a name that yields pretty good, a pretty decent yield, 2.8% dividend yield. And again, that's basically just the dividend that you get versus the share price. So how much are you going to get back from from your investment in the stock in the form of a dividend, in the form of income? And overall, what's impressive is on a name that's yielding pretty well, the price overall has been fairly strong as well. Now, there's some significant swings here. This is just about 50 down to just about 40, so that's a 20% drop pretty quick. But overall, it's recovered that nicely. And what's interesting about this chart is that $50 level. If you've watched the show for a while, I love to talk about big round numbers. And while that might seem like a silly thing to do, I've looked at academic research that proves out that stocks rotate around big round numbers. And I would argue, while they struggle to make this direct relationship, I would argue it's because of the way that humans are wired. We tend to think of big round numbers as having special meaning. So it's not surprising when we're putting orders, and even when a computer's modeling investor behavior, it recognizes the importance of those big round numbers. So the reality is Pfizer got up to around $50, came off, broke back above it, and now tested that breakout level from above, and now rotating back higher. What's great about this sort of chart, number one, it's overall fairly constructive. Number two, the relative strength improving. Number three, you have a clear level of risk. And what I mean is you have a pullback level, pullback to around 50 that would, as long as we remain above 50, overall, the trend in this chart remains fairly strong. Breaking below 50 would tell you things are changing a little bit and you need to reassess the overall situation. But I find a chart like that, there's a lot to like there. Now, there are a number of charts. If you look at the biggest gainers today, it's a lot of names within that same group, in the pharmaceuticals group. So I don't want to go through all of them, but I did want to highlight a different name, same sector, healthcare, but different group. This is Cerner, which is in the medical equipment group. Still a pretty big cap name. This is about a 23 billion market cap. But what I like about this chart is it's more in the improving phase, right? This is a chart that overall has been relatively sideways. The relative strength has been fairly negative for the last couple of years because on an absolute basis, really haven't gained much ground. And as a result, the market overall has been doing very well. So you haven't done well on a relative basis. But I'm starting to see some improvement here a little bit. Stable support level around 70, which is nice to see that it was able to bounce off of that level after finding support through much of October, again in late November, early December, now rotating back higher. With this sort of chart, as it gets above its 200-day moving average, you want to see follow through. You want to see an indication that buyers are taking control and investors are interested in paying more for this name than they have before. So I think getting above 78 is an important one, but a lot of names within healthcare are actually bouncing higher today. Names like this that are more sideways, are they able to eclipse those previous highs and push higher a little bit? Just want to address Moderna as well. When you think about Pfizer, I immediately think of Moderna. And while the charts are very different, I think that's an important lesson here. While these charts overall have done well, and Moderna has certainly had an atmospheric or whatever the word is for an incredible rise, but a huge rise, obviously since the pandemic sort of has evolved, and Moderna has become a name that, while many of us may not have known it before, you certainly are aware of who they are and what they do now. You can see that this has been quite a choppy period. And, again, I tend to think of this more like it's a meme stock. It's more like a cryptocurrency, huge upside potential, but huge volatility as well, right? Potential reward, but also potential risk. So the challenge here is managing your downside exposure pretty well. What's interesting about this chart, though, is after the nice run through much of 2020, continuing in 2021, made all-time highs there in early August. From there, stalled around $500 a share, big round number, rotates back below the 50-day, below the 200-day, but doesn't really follow through there. And now it's settled into where you have support around 225. And I think that's an important level to watch. Can Moderna remain above 225? can it start to make more ground and retest some of those previous swing highs, get up to the mid 300s, which is where it topped out at the end of November. I don't have a problem with a chart like this as long as you manage the risk, as long as you think about the downside potential. I think 225 is a really good technical way, a good line in the sand based on previous support, and if that's able to hold or not. Just to finish off here, I wanted to look at one or two more charts, and then we have to go to our we have to wrap the show and finish it off here. What I wanted to do to finish off was look at the FANMAG stocks. These are the 6 sort of mega cap tech consumer communication services names. What I wanted to point out today was only one of the 6 Meta platforms is up today, up 1.4%. All the other FANG stocks or FANMAG names are down fairly significantly. It depends really on which one you're looking at. The FANG index is down even more because then you have things like Twitter and Tesla and other things that are part of that broader index. This sort of FANG plus. It's the FANG names and a bunch of other FANG-like types of charts. But if you look at these 6 names in a vacuum, you can see that we're going to look at 2 of them, Meta, and we're going to look at Amazon. Meta is up today. Amazon is down, and let's look at the 2 of these. It's so hard to call this Meta and not Facebook, by the way. I'm so used to doing it, but that's okay. As we continue on here, right? So the chart of Facebook looks a lot, honestly, it's similar to the chart of Moderna that we're looking at, right? This is a name that's coming off of all-time highs earlier this year, has come down quite a bit, and now it's trying to regain its footing. The problem I have with this chart is the fact that we've had a pretty consistent pattern of lower lows, right? And for a chart to look more interesting to me, I'd want to stop making lower lows. That first higher low is when it really becomes interesting because that tells you that things are starting to improve. So yes, it's regained 2 moving averages. That's encouraging. The relative strength, not quite there yet because it's still pulling back. It's in pullback mode while other things are breaking out. The other thing I wanted to highlight in this chart was the momentum, right? So the momentum characteristics, the RSIs remained below 60. In November, when we had that last bounce higher, the RSI never really regained 60. And that means the whole RSI is down in a bearish range. What I would want to see to get interested in a chart like this are 2 things, maybe 3. A higher low would be great. Number 2, breaking above the previous swing high around 350. Number 3, the RSI getting above 60. We have not seen those 3 things happen yet. And then finally, Amazon. And when I think of markets that haven't gone anywhere, charts that really have not gained any ground in quite a long period of time, more than you might think, 2 things come to mind: small caps and Amazon. The small cap index, the Russell 2000, tried to break out and failed earlier this year. Amazon tried to break out in July of this year, retested that in November, and it's just failed to make any ground. Who would have thought, given this environment that we're in, we're all at home, shopping online a ton, Amazon is not able to gain anything. So until you see some improvement here on an absolute basis, or definitely on a relative basis, it's not a great chart to look at. We need to wrap today's show. Go to the 3 and 3 charts in 3 minutes. We'll do it quickly. Here we go. Chart number 1 is the ratio of consumer discretionary versus consumer staples. This was inspired by a chart we used to have in the Fidelity chart room, looking at offense versus defense. I'm using the XLY and the XLP on the top. At the bottom, it's the equal weighted version using 2 equal weighted ETFs. You can see that both of these ratios are coming off after making new highs in mid-November. They're both now making new swing lows. This is a concern because one of the great inspirations to remain bullish has been this ratio continuing to go higher, particularly on an equal weighted basis. It tells you investors are more into things they want than things they need. This is rotating higher. The last 4 weeks have been showing you the exact opposite, getting more defensive. Speaking of defensive, the second chart is the utilities sector, the XLU making another all-time high, settling in right around $70 a share. I'm encouraged by the fact that utilities are breaking out. I'm encouraged by the fact that the relative strength, which has been going down for so long, is at the very least not going down in the tactical time frame. The problem is you've had this pattern before. If you look back in July and August, I got really excited about utilities because it made a new high, broke above resistance. The relative strength starting to turn higher. And that was about it for the trade. It settled back into a range-bound move. The relative strength made a new low. So certainly an actionable chart to watch, certainly interested to see if this defensive sector remains elevated, because that, again, is another area, I think, of a little bit of concern if you're bullish overall in the market. Finally, Pfizer, a lot of charts breaking out and breaking down at any point Here's a name making new all-time highs, new closing highs today. Nice bounce higher. And again, on these charts, there's a lot of movement, but overall, I like names that have broken out, that have retested a key support level. And what that does is it immediately, number one, tells you that the pattern is overall constructive, but also has a built-in risk assessment, right? Has a built-in stop for you. We remain above that swing low around 50, and overall, the chart is fairly constructive. We start to fail at 50, then you have to worry about potential further downside. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. We have so many great interviews. Go to StockChartsTV.com to watch them all. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.